All right, guys, in this episode of We Talk Money, we are doing a a technical analysis class, I guess, just looking at a whole bunch of charts. We're going to talk about what opportunities we see out there, talk about some things that were hot, I guess, just last week that now are not so hot, including inflation and how China is now experiencing deflation. Nikki, I think you said you had a couple of questions that I think we should maybe kick this off with.
Oh, you want to start with the fun questions?
Let's do it.
Okay, so I found these on Twitter, and I just thought they were great questions for to start conversation around. So the first one it's from someone on Twitter, the Steich, Zach the Steich, and it's: would you rather have $1.5 million lump sum or $5,000 per month for the rest of your life, adjusted for inflation?
Adjusted for inflation, or like, do you get, I guess, yeah, the question is like, what's a million compounded at 10% for 30 years and then 5,000 a month?
5,000 a month.
So 60,000 a year compounded for 30 years, right? That's how I think about it. How do you guys think about it?
Inflation. Well, I think it depends on your life expectancy for one, right? Because if your life is going to be another 50 years, the math may look different from someone who is going to live another 20. So that's like where you start. But I mean, usually a lump sum is going to win out because you can compound that, and you're probably going to have more money with the lump sum. That's my answer for sure.
Trav,
it's pretty simple. This one's actually pretty simple. Yeah. You take the lump sum, like Nikki said, and the reason you take the lump sum is that $5,000 a month today is about $60,000 a year, and so versus the 1.5 million lump sum, you're earning about a 4% return, and so they'll adjust that via inflation. So your real return maybe is around 1 or 2%. Continuously, because again, it'll adjust with inflation. But today, a 4% return isn't even that good. It's actually arguably not even beating inflation this year, right? So yeah, long term, maybe it slightly beats inflation. But the 1.5 million, if you have any ability to grow that above the rate of inflation or above, say, 4%, 4.5%, you're gonna come out ahead generally. So yeah, it's almost a no-brainer to take the lump sum here, but maybe there's some situations where you wouldn't, but I think the lump sum is the way to go.
Probably
Plus,
somebody.
How am I going to buy a bunch of NFTs with 5,000? I need $1 million now. Actually, I think with $1 million, I could pretty much buy every NFT that's out there right now. So,
yeah, I mean, hell, you could buy with $1.5 million bucks. You could buy treasuries right now, earning 5.5%. So, at least for a couple of years, you would be beating the $5,000 a month just by investing in a low risk asset for 2 years.
Exactly. So, talking about low risk assets, let's talk about NFTs. So I've been doing some research and just trying to figure out, like, okay, what does this look like? Because the bubble has completely imploded back to pre-bubble levels. Taking a look here for you guys listening on the podcast, we're looking at just the number of NFT sales by day. And you can see that, the bubble with NFTs really started in the spring of 2021, hit its max peak in the spring of 2022, and then has been deflating since then. And we're now hitting lows that far are lower than when the bubble actually even kicked off. So I tweeted today and I asked everybody just a few minutes ago, I said, hey, do you think NFTs are going to have another boom, or are they dead forever? And it looks like it's pretty split. 51% think that another boom is coming, and 49% think that NFTs are dead forever. So I've just been, kind of getting caught up and looking at some on-chain data and some other fundamental data, just trying to create, I guess, just an idea of what I think the next boom is going to look like, and if NFTs are going to be a part of that, and if so, how. As I've said many times on the show, I've never been a huge fan of JPEGs, but I think that NFTs in gaming could be a big potential. That's really yet to take off so far, but there are a few projects that I think are making some big headway on that. Do you guys have any opinions? Do you own any Bored Apes or any, rocks that you paid $1 million for?
No. I know people made a lot of money doing this, but I guess it's similar to trading. You have to know your market environment to be able to make money doing this.
Yep.
And the market environment is not there, I don't think, anymore. But I mean, I'm sure that there's the gaming side of things I'm just not as like hip with, so maybe you guys can speak on that better than I can.
Yeah, I know it's a pretty contentious topic, but the idea is that you work in NFTs into the game, and if you have verifiably scarce assets that can get you a leg up in a digital world or a game, I think there's definitely value there. We saw a lot of implosions around the play to earn situation with Axie and other projects that have kind of imploded since the bubble 2 years ago. But yeah, I'm not giving up on NFTs. I think, during the next bull market over the next year to 2 years, I think we're going to see a comeback. Is it going to be JPEGs? I don't know. I think JPEGs that have utility in some kind of game, I think have a higher likelihood of actually gaining a bull market, where a lot of the ones that we've seen from this last cycle, I just don't see them coming back. I could be wrong, but I just don't see it.
I'll tell you who could maybe put out a successful NFT. Taylor Swift.
Oh my God. You're not wrong.
I know.
Because people will just buy whatever she puts out. I mean, yeah.
Okay. It was just a joke. It was just a funny.
That actually, though, makes a ton of sense, because I think, if you think about collectibles generally, forget NFTs for a second, what collectibles continue to gain value over time historically, and they've generally been things associated with either very famous people. There are some, sports figures, even, past sports figures. Obviously, a lot of their memorabilia has retained value. Anything that has, a lot of sentimental value that's very scarce. So even things like old consoles and things like that now. So I do think celebrities could be one place where we do see a big NFT comeback. It's like in the last cycle, we just didn't really see anyone do it well. On this podcast, we talked about how even Gary Vee, who was super bullish NFTs and really dug into the space, like his own NFT didn't offer that much utility or value. So it's really comes down to the design of these NFTs and like how can they innovate it to make it better and more valuable for the holders of the NFTs? Because last cycle it got a little bit stupid, right, with the JPEGs, and obviously some people made money and got out. But I think the next cycle, I think Chris, you made a good point, which is I don't think it's dead. I don't think NFTs are totally just gonna go by the wayside and we'll never hear of them again. I think the next iteration will be hopefully better, and we'll get another cycle with maybe more innovative and more NFTs with utility. That's what I'd like to see.
Well, talking about utility and Taylor Swift, I think something that I haven't heard recently about is just the whole concept of concert tickets with, NFTs to help with the flipping, right? Nikki, you can tell everybody your story about trying to get on the list for Taylor Swift tickets, and how if you're going to buy from the, the secondary market, you're paying thousands of dollars, where the original tickets are a couple $100 maybe. But
yeah,
if you could tie it to a human and make it so if you do transfer that, a lot of the revenue either goes back to the artist or something creative, to where it's not just the scalpers that get the money. I think that is massive utility, and that could really help the economics of a fan for someone like Taylor Swift.
That is the biggest problem, is right now the only way to get Taylor Swift tickets is to basically register before the tickets even go on sale for the option to maybe get a code sent to you to buy tickets. So it's absolutely ridiculous. And they're doing it this way because it's the best way that they know how to verify that it's not scalpers getting tickets and it's actual human fans getting tickets and not bots, So yeah, I can see how an NFT would potentially kind of solve that problem in a way. I guess if you're a true fan and you own an NFT, that's verifying you as a fan and giving you the first chance at buying tickets. So
yeah, and if somebody does sell the ticket, you could disincentivize that by, saying whatever the markup is, a percentage of that goes somewhere, goes to the artist or goes to a charity or, something, I don't know. But guys, let's jump into the charts. So we've been talking a lot about the recent pullback in stocks. Bitcoin's been holding up. Yesterday, we saw a big pop. Taking a look here at the indices, we've had the NASDAQ and the S&P that's been kind of stair-stepping down. And Trav and Nikki, I know you both have been talking about the potential for a pullback in the markets here. And also Bitcoin has been flat to slightly up over the past week. And right now we're sitting at support. But what is the general theme? What are you guys seeing out there? Has anything changed since last week, or are you guys sticking to your guns and hunting for stuff?
I feel like I posted in the Daily Doe, I think it was the last Daily Doe, the different levels in the S&P 500 that we need to be watching, because as strong as this market, was, obviously we've had a really strong run from the lows, and I was thinking, gosh, this thing looks so strong that we might even test all-time highs sooner than people think. Well, we're getting a nice correction, before that, of course. And the big question that I'm asking myself now is essentially this, the level that I put in was, I think, 4450. Yeah. So basically I'm watching 4450, which we're kind of close to that right now. We're kind of testing a prior breakout turn to potential support now. So the real question is on the technical analysis side here, we've had really shallow pullbacks ever since the beginning of the year. The pullbacks have been incredibly shallow, maybe 23% retracement pullbacks. And so the question here is this going to be another shallow-ish pullback, or are we going to see the market really kind of dump? And I am starting to feel like the sentiment is starting to shift. I feel like the bearishness is starting to come back into the market. And you know how the saying goes, nothing changes sentiment like price. And that's exactly what's happening. So I'm watching this pullback here to see if we're going to get some support from buyers. There is a bit of consolidation happening over the past 4 trading sessions. We've kind of been, if you want to pull up the chart, you can kind of see the past 4 trading sessions. We've been hanging out in the same kind of range right above that resistance turn support zone. Exactly. Yeah. So that is the level that I'm watching here. We're bouncing off of it a little bit today. We bounced off of it yesterday, kind of reversals. So there are some buyers there. It's just a matter of, are they going to be enough of them? Is it going to be strong enough to push this market back higher? Or are we breaking down below that that support level to get a deeper retest to the 4,200 zone? Now, with all of that said, even if we get a deeper pullback to the 4,200 zone from here, I still think overall price structure is quite bullish, even if we do get that deeper correction. So that's kind of the game we're playing here, is we really have to pull back and we have to zoom out on the chart to see that even though the bearishness is starting to creep back in, on the bigger picture, we're still quite bullish in terms of price action.
Yeah, we could pull back, even in the low 4,000s on the S&P and still be in technical bull structure. And that's kind of the same idea here with Bitcoin, as we've been making higher highs and higher lows. And we've been in a consolidation zone in Bitcoin really for almost, over 45 days. And right now we've been bouncing off of that 100-period moving average and the sweet spot retracement. And so price structure is absolutely bullish, but that doesn't mean we have to break out. We've got this 31K, which is a massive price resistance level from the past 3 years. And so if we get through that, there's open air to the upside. So this is kind of like, I said this in the crypto market update, this is like the final boss, that if we get through 31K, I just think there's a ton of upside. And I think it's good that it's actually taking a while and consolidating here. But a lot of that obviously hinges on what the ES and the NASDAQ do.
I'd be curious to hear from Trav on the fundamental side. And
that was my next question is, Trav, what are you seeing on the fundamentals? Does that support this, or are you seeing something of concern beneath the surface?
You know what? There's something for everyone in this market. Something for the bears and something for the bulls. I'll tell you why.
Facts.
Yeah. There's something for the bears and something for the bulls. Hell, there's even something for the inflationistas and something for the deflationistas. And so you can make good arguments in any of those camps right now, depending on your viewpoint. So it's going to be a real interesting battle over the next couple of months. And so, look, I'll point out a few things. Obviously, we're in the middle of earnings season. In the very first week or two of earnings season, things look pretty good. We were seeing pretty good stock price continuations on what were pretty good earnings beats. And that kind of shifted last week. Last week, some of the macros started getting into the picture. Some of the reactions to stock prices became more negative. Over 1,260 companies reported last week, and the median return was actually negative. And you had a number of blow-ups. And so even today, even this week, we've seen the same thing, like stocks that look like they were going to go up after earnings, like your Palantirs, your Lyfts, et cetera. Those are actually down significantly today. So we've seen kind of reversal. I think part of that is because a lot of stocks went into earnings season with too high of expectations. People have finally started to think about valuations again. They've been a little bit nervous about what's going on in bond yield world. And last week, of course, we had that big, whole thing about Bill Ackman shorting long-term government bonds because he's worried, he's in the inflationista camp. He's worried about rates having to go massively higher than the stock market thinks. For much longer because of the fiscal position of the U.S., et cetera. But on the other side of the fence, look, I think there's some weakening economic signals. We got the JOLTS job openings data last week. They were kind of weak. Some of the leading economic indicators are kind of weak right now. UPS reported freight volumes down 10% in the most recent quarter. So clearly the goods and manufacturing side of the economy is still not really there as far as improvement. So there's definitely some things out there that, have the bears concerned. However, on the flip side, we still have very, very low unemployment. We still have consumer spending that looks okay. We still have GDP estimates that are being revised higher, above 4% now in the Atlanta GDP now, the forecast of GDP going into the next quarter. So it's a kind of an environment for something for everyone. You can make your own case really with what's out there in terms of the fundamentals and the data. I would say personally, I'm a little bit more worried about deflation as we go into the later parts of the year, because I think, we might get a head fake in CPI and the bond market might freak out like it did last week a little bit. But ultimately, we're headed for lower CPI numbers due to shelter. And frankly, I think, the economic environment is good, not great. And so I'd be a little bit worried of things rolling over as we go into the late parts of the year. We probably won't see that in the fall, but that's what I'm kind of planning for 6 months out, is maybe things being weaker than expected as we go into the later parts of this year. So that's kind of where my head's at. It's hard to get too aggressive here until we get a buyable pullback like you both have talked about.
Trav, let's dive in a little more to the whole interest rate situation, and specifically what you wrote about in the Daily Doe about Ackman's next bet.
Yeah.
Well, we know that there's been quite a bit of movement on the 30-year bond. There's kind of a big breakout last week and then a little bit of a pullback this week. So what are we seeing with the yield curve and with longer duration treasury bonds, and what was Bill Ackman's bet?
Yeah, interesting timing on Bill Ackman coming out and saying that he's short long-term treasury bonds. Where was he at on this trade 2 years ago? When long-term government bonds were super, super high and yielding super, super low rates, right? They were like less than 2%. That's the time when you want to be shorting 30-year treasury bonds. Now the picture looks a little less clear. The rates have risen a lot. Those bonds have come down a lot in the past year. He thinks there's still some juice to be squeezed out of the trade on shorting long-term government bonds, because he thinks rates still need to go higher on the long-term government bonds. And look, I agree with him that the U.S. fiscal spending has been a bit out of control. 5.5% deficits even this year, still pretty heavy. Interest expenses going up because of the rates on debt are higher. You certainly have some questions there long-term. But, I think it's kind of late in the game for this trade. And Bill Ackman is known for making his trades public when it's already sort of happened. We go back to when he was on CNBC during the pandemic crying and saying that, the world was ending. And then 2 weeks later, the market ripped higher because there was fiscal spending, right? So he made money on his trade back then, but he used a CNBC appearance, I think, for exit liquidity. So we have to be a little bit careful here about Ackman making his trades public because he wants people to jump on the bandwagon so he can exit his trade to them,
Yeah.
Interesting too, because Buffett, is continuing to buy government bonds. However, he's buying at the short end of the curve where we've been buying. He's buying, these 5% plus yielding short-term treasuries where you basically are not really at risk because the government is not going to default in the next year or two. You know, on a 30-year time frame, a lot more questions about things like fiscal spending, demographics, those types of long-term concerns. In the short run, you know, the U.S. government has its own money printer, and you know, there's not a debt ceiling issue where they're going to default in the near term. So I think it makes a lot of sense that Buffett's buying short-term treasuries to earn that 5% plus yield, risk-free, essentially. As far as Ackman's long-term government bond bet, you have to be pretty certain about a lot of long-term factors. And I talked about that in the Daily Doe. And frankly, I don't know. I'm not sure if I buy the trade at this point, but it will be interesting.
You know, one thing that is actually kind of supporting that, another chart that looks like, hey, rates could be about to squeeze much higher here.
Yeah.
Check this out.
Oh, yeah.
This is the 30-year mortgage rate chart that just came out today. What was the number? It was just over 7%, 7.09. Was it? What was it? Yeah, 7.09. Look at this chart. Looks like a bull flag rather, about to squeeze above 7%. I hope this is a double top, because if mortgage rates squeeze to 8 or 9%, the real estate market is absolutely screwed.
This is why I think, sorry, just real quick, this is why I think there's something for everyone in this market, the inflationistas and the deflationistas, because if you think about, you know, how the path dependence might work, what might happen is over the next 2 to 3 months, we could see a blow off top in rates and a blow off top in mortgage rates. And that itself becomes a deflationary force, because again, you kind of crush the housing market. You crush anyone who's borrowing money, anyone who has to refinance corporate bonds. You probably have credit spreads blow out a little bit. You probably have equities pull back. So that reduces the wealth effect. And you also have this whole issue with the CPI. It's probably, we get a reading on the CPI tomorrow. It's going to be July's inflation reading. And it's likely to tick up for the first time in terms of the year-over-year inflation rate. It's likely to be higher for the first time in 11 months. And if you look at forecasts for the August rate, which will come out in September, the CPI may be as high as 3.9, whereas we just had 3% in last month's reading. So again, you have a CPI that looks like it's ticking up, at least in the short run, because of things like energy prices that have recovered. But if you actually look at the forward curve for inflation projections out until November, December, it falls back down significantly to under 3%. So this is kind of a head fake that we might see. We might get this head fake in CPI that's going to spook a lot of people, potentially send rates higher. And that's what actually creates an even more deflationary force. Maybe you have problems in the banking system. Maybe you have the housing market get crushed. And that becomes ultimately the force, the deflationary force that will create or potentially parts of the economy and lead to the Fed having to cut maybe early 2024. So maybe both sides are going to be right, and it's just a question of timing.
I guess my thing is like a pricing of houses. We thought that would budge more than it has. Like in certain markets it has, but like overall, housing prices, even with these higher rates, are not really budging.
Yeah.
So because of the inventory issue, right? And because 80% of people are locked in at 4% or less. So it's creating this interesting dynamic in the real estate market that for residential, I don't know if I'm convinced that if rates tick higher, it's going to help housing values go down.
Here's how I'm thinking about it, right? So nobody that, when I say nobody, I mean the vast majority of people that have a house and have a mortgage at 2, 3, 4% rates, they're not selling, right?
No.
So where's the supply? New home builders, right? New home builders are at all-time highs right now, right? How do prices come down? Well, I think in Trav's scenario, if we get a blow off top, say rates go from 7 to 8 or even 9%, the 2-1 buy down is no longer attractive, because if you do a 2% buy down on 9%, you're still paying 7% interest. And most people just won't do that. Anybody that was shopping for a house is like, screw that. And so builders will have to be the first ones to really start dramatically cutting prices. And then that might entice people to do a 2-1 buy down if they know their prices are going to be a lot lower. And Nikki, didn't you have another question that was around housing, like a would you rather type?
Yeah, it's and I actually know the answer, but it's from the Wealth Coach on Twitter, and they said, would you rather buy a 500K house at 7% or an 800K house at 3%?
What's the math on that?
So with nothing down, let's just go straight 500,000 at 8%. You're looking at a payment of $3,600. interest over the life of the loan, $820K. And then at 800,000 at, what was it? It was 3%. You're looking at a payment of 3,300 and half in interest paid, 400K paid in interest. So the answer is you would probably rather have based on the math, an 800K house at 3% versus a 500K house at 7%. You're going to pay more over the life of the loan because of the interest.
There's other variables too, like property taxes, which are in perpetuity and they only go up over time. But
I didn't put any of that in just to give us the straight, principal and interest.
And it gets tricky too if you think about the option to refinance at some point, if you do believe interest rates come down, things like that. And so, it's difficult to figure out the apples to oranges, or the apples to apples there rather, on those analyses. But I think what's interesting as far as a trade idea here, XHB, the home builder ETF, if you think 10-year and 30-year government bond yields are going higher, and therefore 30-year mortgage rates are going higher, at least even just short term, even just for a couple months, the trade is probably short XHB, the home builder ETF, or short housing related stocks, because they're still doing quite well. The XHB is really almost right around its yearly and multi-year high still. And yet, mortgage rates 7+%. At some point, Chris, like you said, if they're at 8.5, the housing market will see a big fall off in activity and prices will come down. You don't even need a lot of volumes for pricing to come down. What happens is you have people that have to move, and you have people that, have to sell their house. And so there will be some volume in the housing market. Even in 2008, 2009, there was some volume being transacted in the housing market. And those transactions will set the prices, and those prices will be down significantly. So you will have at some point, if mortgage rates really do hit 8-9%, you will have some pain in the housing market, and you will have prices decline probably more than what we've seen year to date. So maybe the trade here, if you think rates are going higher, is short XHB. But again, you have to be cognizant that, things can change a lot in 6 months with rate policies and where rates go.
Yep. Yeah. This is such a strange situation because we've got a locked existing housing market. We've got people flooding to new builders, but we've got rates the highest they've been in decades. I think a blow off top would absolutely just freeze whatever was left in the housing market. And that would be the one thing that could budge prices. If rates stay the same or even go down, I think that's just going to add fuel to the supply shock, right? But if rates did come down, maybe more people would be open to selling too. So that would increase supply. Oh no, there's so many variables, right? There's so many strings to pull. And I've seen a lot of people on Twitter talking about the whole speculative bubble of Airbnbs. And there was a chart. I don't know if you guys saw this going around. I think it was Phoenix. It was like a map chart of like rental prices and how they all had arrows showing that there was drops. Did you guys notice that?
Mm-hmm. Yep.
So I know there's, certain places where, a lot of people were listening to like TikTok financial gurus saying, hey, go ahead and buy a single family house in a regular neighborhood and Airbnb it out. Mm-hmm. Yeah, that can work, but you're basically thinking of that as kind of a carry trade. But if you're not in a high demand area, I can see how you could really get screwed on something like that.
Yeah, yep. I think that I don't know if you guys have been noticing this, but I've been noticing like more Airbnb availability than normal, like even around big events. So I don't know. I don't know if that's just anecdotal, but I'm sure it's slowing down in certain spots.
Well, we talked about, what was it, about a month or so ago that tweet went viral. And Trav, I think you even wrote about it in the Daily Dose saying how, no, Airbnb demand is not down by half. It is down, but not that much. And it's not going to lead to an implosion. But I don't know. It's definitely a weird situation.
Well, I do know people personally with Airbnbs in Austin, many Airbnbs that are breaking even right now. Potentially like slight losses. So the property
were they profitable before, or is that normal?
So some of them were purchased during during the peak like at the high.
Uh-huh.
Yeah. And then some were purchased before COVID even happened. But they're breaking even. They're not actually like profiting. So I don't know. I think that it does depend on where you are, but Austin has been a particularly difficult market depending on when you got in, just because they did see a hit in housing prices. Gotcha. Contrary to what Dave Ramsey says.
Mm-hmm. Well, we'll just have to keep our eye on it. I know I'm not making any moves. I've bought what I've bought. I'm over-indexed on real estate right now. I feel good about it, but if we have a big crash, I will definitely be looking to scoop up more land. That's what I really want, is like land and areas that I'm bullish on over the next couple of decades.
Yeah, I can't help but wonder if the migration out of cities is going to continue. I saw something today about how like cities are literally hot boxes. The all the metal and the cement and like everything is just making them even hotter and hotter every single year as they grow. You know, as they grow, there's more cement, more metal, all of that. And it was an interesting idea. And I was like, yeah, these cities, I mean, I know Austin. I look at the weather there and I'm like, ugh, it's rough.
I feel that.
Have you stepped outside recently?
Only when I have to. And it's been about 104 or 105 with not a lot of shade, not a lot of wind for basically the last 20 days. And at least for the next 10 days, it looks like it'll be the same. So yeah, it's been pretty brutal. Definitely a brutal summer. I feel the extra heat on the pickleball court. That's for sure. So yeah, we're looking forward to fall, and it's been a particularly brutal couple of weeks here in Texas, Central Texas.
Fall will be like 95.
Yeah, yeah, we'll get it down to the 90s at least.
105 to like 95. Yeah.
October will be nice. October hopefully will be really nice. Maybe in the 80s.
Yep. Hey, guys, let's talk about Travis's favorite stock, Tesla. There was something that went down. Nikki, I think you may have shared this today. There was some kind of crash. What happened with Tesla?
Are you showing the video? There it is.
Yeah.
It's this Tesla on autopilot couldn't detect the emergency vehicles parked in front of it in the same lane. Like, here it is. It's right here. So here's the Tesla.
Oh, this is the crash cam.
Yeah, and it's
boom. Oh
yeah.
shit.
So it apparently the auto pilot is having a hard time detecting stationary vehicles. Like, it detects vehicles in motion around it, but stationary vehicles are apparently an issue, and they're now being investigated because I guess there are a lot of people that try to get around the how you have to have your hands on the wheel, or you have to the driver alertness thing where there's a camera in the Tesla and it's looking at you to make sure you're alert and you're not screwing off and in the back seat while your car's driving. And apparently people are like finding ways to get around that and putting tape on the camera and all kinds of crazy things. So I guess that Tesla is starting to finally, I actually know somebody personally who got in a really, really, really bad accident and almost lost both of their legs and became paralyzed from an autopilot car accident. The car literally was on the highway on autopilot, no hands on the wheel, ran him off the road into a ditch, and he got in a really bad accident. So, like, I guess now finally people are starting to wake up to this, and it's getting investigated more heavily. And I don't know if it's going to be more regulated or what's going to happen from here. But the issue is Tesla's marketing. Tesla has marketed the self-driving as something you can trust and, blah, blah, whatever. But obviously people are not using it properly or recklessly, or maybe they are using it properly and it's still messing up.
Yeah, it's pretty terrifying. The thought of like, I recently started driving a motorcycle just on back roads and stuff, but the thought of like this big ass like Cybertruck coming down the road on autopilot and then just smearing people, like, yeah, it's I don't think we're ready. I know Elon's been saying next year for almost a decade now. Trav, have there been any more developments in this space, or is it still like the same old?
It seems like it's mostly same old as far as like the regulators being behind the curve and not really knowing what to do, and Tesla continuing to basically beta test on public roads. And, Tesla will say it keeps getting safer with every release, and maybe it does, maybe it doesn't. I don't know if I would believe the data straight from Tesla, especially given, what we've heard out of Elon's mouth, like he said, for the better part of the last decade. But the autonomous driving space has gotten more interesting in the last couple of years. You actually have companies like Waymo and Cruise that have gotten into the game with, the autonomous driving services. And so you can right now in Austin and Phoenix and places like that, you can go hail an autonomous car from either Waymo or Cruise, and they work pretty well. I've had friends that have tested them and that have tried them out, but there are edge cases. There are edge cases for all of these things. And so the question is, like, what's the right approach? Who's doing it safely? Who's doing it in the right way? And, I have my opinions about it. Probably wouldn't be that probably wouldn't appeal to the most bullish of Tesla fans, but that's okay. I think eventually this will all probably be safer than human drivers. But the question is, are we going to accept errors? Because there will still be errors with autonomous driving, and you're never going to eliminate all of the crashes and fatalities. So the question is, do we allow the autonomous systems to have the errors? Do we allow them on the roads if they're still having errors? And what is the acceptable error rate? And that's something that I think is going to be really, really difficult for people and regulators to come to terms with. And there's going to be, I think, a lot of cities that are just like outlawing it because, they say that any fatalities or any errors are unacceptable, even though we know humans are making a ton of errors every day, right? So it's really tricky, I think, to figure out. I don't envy regulators who are trying to figure it out. But I also don't think a completely laissez-faire approach and beta testing on public roads is maybe the best decision either. So, I have very mixed opinions.
I would rather trust self-driving in a city where you're going slower versus on a highway where literally your life is completely at stake. Not that you can't lose your life in an accident in the city limits, but you're going so much slower that it's just the odds are you're probably going to survive something like that versus what happens on highways. So that's I would rather test that than the other way.
Yeah. All right. Guys, I have another question. I'm still very confused about where we are with this whole superconductor thing. I know last week it was like massive news. It feels like it's kind of cooled off. I've been scrolling through this public Twitter list that somebody created. It's called the LK99 Updates Army. And it looks like the tests have been recreated, but it's maybe not a legit superconductor. Is that your understanding?
That seems to be where the Twitter hive mind is at right now with LK99, at least the people that were, very prominently talking about its potential 2 weeks ago or 10 days ago. A lot of them just in the past, I would say 4 or 5 days or so have started to become a lot more pessimistic because there have been a couple of papers out, there have been a couple of replication attempts out that suggest that there are some interesting properties with LK99, but it doesn't appear like it's a room temperature superconductor necessarily. However, there's still people pushing back on that, saying, well, a lot of the LK99 samples that have been made for replication have not really been properly treated the same way that the South Korean scientists were doing. So I don't know. I think there's still probably a lot more to come as far as figuring out what exactly has happened here and what's real and what's not. But it does seem like things in the community among Twitter watchers has shifted to more pessimism rather than optimism like we saw a week or two ago. And, I took a trade on American Superconductor, and unfortunately I'm down about 20% on that right now and have been considering exiting, but, they report earnings, so that could be another big risk potential there. So I mention it because we don't just shout out our winners, right? I like to also mention some of the losers where I took a shot at it. I thought maybe this could be a 3 or 4x situation if things start to replicate successfully, but it hasn't worked out. So I may take a graceful exit on it.
The chart is still intact.
Breakout level. Basically what happened for anybody that's listening to the audio, there was a breakout around $8 here, kind of right before the news popped, and had about 4 days of upside and then one big down day. And looks like, Trav, you tried to buy the dip and it's just been kind of grinding lower, but it's still above that breakout level.
Yeah. Bought the dip at around 11, and I should have maybe stayed away and waited for things to settle out first. But yeah, it, like you said, it hasn't completely broken down, but they do report earnings, so anything could happen at this point today, and we'll see.
Have to keep an eye on that.
Yeah.
Nikki, what have you been trading recently?
Recently, not much, because a lot of charts fell out of tact because of earnings. So like there were a few charts set up like for just short-term trading opportunities, and they reported earnings, and then the charts just completely sold off. So I think like one of them was Fubo. It was just a technical only type of setup, possible breakout. FUBO, and I was watching the 325 level for a potential breakout zone because the chart was set up pretty nicely if you zoom out on it, but it ended up, earnings ended up not being good. I know that on the trading side, like Nikola looked like it was breaking out, but then that had earnings and that fell off. So the trading environment kind of has taken a slight turn. Things were looking really, really bullish on the short-term trading side. There were tons of charts setting up. Some charts broke out, like Nikola did, for example, and then the charts just kind of fizzled. So again, it's about knowing your environment, and thank goodness I didn't get in any of these, but basically just kind of resetting, and we'll see what happens over the next few months if charts want to reset again. So that's kind of where I'm at. I'm honestly more so interested in now. I feel like we're in an environment where I have cash in my active stock picking portfolio to deploy that I haven't deployed, just kind of waiting on the right opportunity. So that's where my mind's at right now. I'm diving into the fundamental research again, and just trying to find places to park some active capital for longer term investments. And a lot of that I had to kind of wait on earnings reports to see where things were heading. And I just want to see some pullbacks. I'd love to see some bigger corrections, Shopify's correcting. What other
You got
ones?
Etsy. Etsy's now starting to look pretty cheap. I know that's been on your watch list.
Yeah, Etsy's one that I started diving into the fundamental side on it. It's finally getting cheap enough to where I'm interested. It's been quite expensive. I ended up buying Poshmark, which is kind of like a competitor in a way. And they ended up getting bought out, so you can't even see their stock anymore. But they ended up
where'd the chart go?
Yeah, they got bought out. But yeah, so that's where I'm at. I've kind of shifted. We were in that short-term trading environment, got the Carvana trade, did all of that. And then now I feel like things are shifting back into corrections and a lot of stocks that fundamentally I'd be, interested in owning long-term and deploying that capital eventually.
Nice. That's kind of where I'm at too, is I've been in a holding pattern, just waiting on Bitcoin. I've still been holding part of my long, but as far as the altcoin situation goes, I mean, we're still in this kind of confirmed bear market. And I've been waiting for a breakout of this kind of downside channel. Things have just been really kind of bleeding out, which is, it's just a part of the market cycle. So as soon as we can start to break like this 400 billion market cap resistance area, that's when I think we'll start to see another alt season. But as of right now, the gains have mostly been dominated by Bitcoin and just a select few. We've actually got a little bit of a move on Ripple this week, believe it or not. Back here on May 13th or July 13th, we had a big pop on the Ripple lawsuit news with the SEC. And then that was really it. It was like a one-day pop. And then ever since then, the market's just really been fading off for like the past like month. But as of today and yesterday, we had a little bit of a pop off of the 50-period moving average. And so I'm just kind of keeping my eye on a handful of tickers here that were showing relative strength above Bitcoin. We've even got some oldies like Link and a few others that have been showing some relative strength, but we're just not quite there. But I'm honed in, and I'm doing a lot of research and looking at some on-chain data and just really kind of hunting for those next opportunities. So as soon as I find some, I'll let everybody on the show know. And obviously we'll be alerting our community first. And that's basically it. I've also been evaluating some startup opportunities and ideas and just kind of putting a lot of feelers out there.
Now is definitely the time to put the nose down and do the research. We kind of came out of a period of busyness, at least on the stock side. It felt busy on the short-term side. But yeah, we're back to now. We're seeing pullbacks. We're seeing better valuations in certain areas. Time to pay attention and put the nose into the 10Ks.
Absolutely. Trav, what's on your radar, man?
Yeah, we got that big CPI report out tomorrow. Obviously, we're still watching things like government bond yields, watching the pullback here in stocks, and like Nikki, just kind of digging into what might be interesting after we have this Q2 earnings season. You know, we can dig into some of the fundamentals again and figure out what looks like it got oversold or overbought. So yeah, that's really it. And yeah, staying inside to avoid the heat and just doing work, quietly grinding.
Awesome. All right. Well, guys, we can go ahead and start to wrap it up there. If there's any questions that you have for the show, go to wetalkmoney.com, submit a question. Also, make sure to go to dailydoe.co, sign up for our new newsletter. Monday, Wednesday, Friday, we send out about a 5-minute newsletter where we go over 3 to 4 topics. Also show you guys what we're looking at, what to look out for, and do some deep dives on investing ideas. And yeah, anything else you guys want to talk about before we wrap it up?
I wanted to read a comment from one of our wealth building community members about the newsletter, if I may.
Go for it.
Okay. Kurt says, this newsletter is just so good. It packs everything we need to know in.
Awesome.
I love that. Because that's exactly what our goal was.
The platform we've been using to host it is they allow us to like get reviews and ratings right within the newsletter. And I took a screenshot of a bunch of the comments that have been submitted. It's like overwhelmingly positive. Like this is really encouraging because, you know, we've been putting a lot of time and effort into this, and looks like about 98% of people said that it's been delicious. So we appreciate you guys. We love the feedback. Definitely reach out. Let us know what we can do to improve it. Or if you have any ideas on content that you want to see, let us know.
Absolutely.
We're always looking to improve.
Yeah. And join the wealth building community. Go to wetalkmoney.com/community.
Yep. Awesome. All right, guys. Well, thanks for watching or listening, and we will see you next week. Take care, guys.